Welcome, traders. Welcome to the ActivTrades Monday Market Matters webinar for the 18th of March 2024. It's Paul here, and here we are today to talk about how to trade three-bar reversals. Great to see so many of you here. You're all very, very welcome to join us today. As always, we'd just like to start that making sure that the technology is working in our favor rather than fighting us. So for those of you in the room, if you could just take a moment in the chat box just to confirm that you can hear my voice and that you can see the slides, that would be fabulous. We'd really appreciate that. Splendid. Thank you, Simon. Thank you, Peter. That's great. Thank you very much. Much appreciated. Always helps to start on the right foot, doesn't it? So great to have you all here. As I said, we're going to talk about how to trade three-bar reversals. Just a very simple price action setup that I'm going to be sharing with you today that you can take away and hopefully utilize and in your own particular trading endeavors. And we'll look at that in a few moments' time. What's on the agenda today? Well, as always, we'll have Monday Market Matters. We've got a rather chunky week ahead in terms of news, so we'll have a look at that and a conversation about that. But in terms of our education elements, we're going to be focusing on what is the three-bar reversal, and more importantly for you is, where do you see it on charts, and actually how can you trade it? As I said, it's just a simple price action based setup that you can take away and utilize. Those of you who have joined me for previous sessions will know that I will always try and share setups that are time frame and instrument agnostic, in that they can work across all time frames and across all instruments and asset classes, regardless of whether you trade FX or crypto or equities or indices, fixed income, etc. So that's what we always try and do in terms of what I can share with you. So hopefully there'll be some interesting insights for you that you can take away. And then what we'll do is we'll finish as we look in on the check-in on the live markets. So I appreciate, we generally, we always have some new people joining us for our sessions, and you're very welcome here. The whole aim of Monday Market Matters is to help traders start the week in the right frame, as normally we prepare for the opening of the US markets. You'll actually see that the US markets are already open now, and that's because of the divergence between America has switched to summertime just a couple of weeks earlier than we have ourselves, but that will change back in a week or so's time. But normally what we're looking at is that every Monday, 2 o'clock London time, we take a look at the news so that you're aware of the major news coming out for the week ahead. We'll focus mostly on education, okay, something that'll help you build your trading knowledge. We'll always have a chat about some of the ActivTrades platform and tools that you have access to as a client. And as always, we'll look at the live markets, okay, at the start of the US session. So there is always plenty for us to talk about, always lots for us to cover, and as I said, hopefully lots for you to take away and utilize in your own trading. As I always say, I appreciate that we have a truly global audience who join us for our Monday Market Matters webinar. So wherever you are in the world, you're very welcome. I hope you're enjoying this interesting trading year. And I also appreciate that we have a broad range of trading experience for people who join us, from complete beginners to advanced traders. You're all very welcome. There'll always be something for you to take away. Today, in terms of the three-bar reversal, might be something for beginner traders to be able to take away, something to get their teeth into. But equally, intermediate and advanced traders will hopefully find something in there that they can utilize in their own trading as well. So always plenty for us to talk about. And we always look to start off with the news, and you hear me say it every week here, ladies and gentlemen, namely that if you're a new trader, I do not expect you to be able to analyze the news, but it is very important for you to know when that news is being announced, and there's no excuse for that. And what we have is that you can utilize that or find that data in an economic calendar. And there is an economic calendar on the ActivTrades website that you can utilize, and ones elsewhere on the internet. So there's no excuse not to know when the big economic data is coming out, because that will invariably sort of induce volatility into the market, and that can be a double-edged sword depending on how you are positioned. So it is important to know the news. And what we have is this week is we do have quite a chunky week in terms of there's an awful lot of data coming out and an awful lot of very important data that is coming out, okay, especially from tomorrow onwards. So what we are going to see is that the Bank of Australia tomorrow have their meeting regarding monetary policy, but we also have the Bank of Japan one, and traders are going to be very interested in this to see if Mr. Ueda comes out and gives confirmation of a change in policy, which would involve a raising Japanese rates, something that has not happened for a very long time, and that would be quite a change, quite a shift in the overall sentiment and narrative in global markets, and of course towards the yen and the Nikkei. So people are going to be keeping a really close eye on that tomorrow. We also have Canadian. Okay, you also have Canadian inflation figures. Their CPI is tomorrow afternoon for us here in the UK and Europe, and of course, people will be interested to see whether that has continues its deceleration, which would very heighten interest in how quickly the Bank of Canada would look to cut its own interest rates. That has knock-on impacts, of course, because on Wednesday, we actually have the Federal Reserve will have their meeting on monetary policy as well. And whilst people are not expecting a cut or a change, people will be very keenly keeping an eye on what the actual sentiment, what the narrative comes out of that. And also in the UK Wednesday morning, we have our CPI data here. Once again, looking to see how the inflation figures are affecting the economy, and it is important anyway, but it's increasingly important because here in the UK we are into an election year, and the Prime Minister, Mr. Sunak, is looking for any particular ammunition that he can grasp onto to help him, and so he'll be desperate to hope that those inflation figures are decelerating very quickly. So that means the Bank of England are more likely to cut interest rates, which may help him in terms of, as I said, ammunition for his election campaign. Thursday's a big day as well. We've got Aussie employment numbers. We've got some UK and European PMIs, okay, as well, data coming out. But we also have the Swiss National Bank. They have their monetary policy announcement coming out this week. And once again, people not really expected for any change or difference. We also have the Bank of England. They have their official bank rate vote and statement as well. And as I said, once again, people aren't expecting a change, but they will be looking to see what is the sentiment and the narrative that's coming out of that. And then on Friday, we have UK retail sales, and we also have a European summit that's coming through. So we have an awful lot of data coming out this week, okay, and it's important to know when it is, because what you don't want to be is you don't want to find yourself on the wrong side of data releases, okay. It's about understanding how when that news is coming out, and actually how does the market react to it, okay. That can be enormously educational for traders. So make sure every day you sit down to trade that you look at you do look at the economic calendar, and you understand what big data is coming out that day and whether it is relevant to the instruments that you particularly trade. So, as I said, there's the news there. So let's have a little chat about our education piece instead as well. So, what we're looking here today is, of course, to talk about the 3-bar reversal trading setup, how to trade that. Well, of course, it would help if you knew what a 3-bar reversal was to begin with. And let's bring up the old drawing tool here for me to help. What is useful for us is that it is a simple mechanical trade setup that is not unsurprisingly created over 3 bars. And as I said a little bit earlier, it is time frame and it's instrument agnostic, meaning it's set up across the spectrum, because I do appreciate that we have lots of traders who join our sessions or who watch this on the webinar archive on the ActivTrades website, who might trade all sorts of different time frames and all sorts of different instruments. So, as I said, these setups, you see these setups across the spectrum. However, today we're going to focus on what I particularly trade, namely Forex, indices and commodities markets. That's what we're going to particularly look to focus on. But as I said, They do set up across all instruments and time frame. What is of interest to us is that the location of where that 3-bar setups creates the condition for the trade or not. So we're going to use a simple filter to help give us an idea of when is the best time and place to actually utilize the 3-bar reversal trading setup. So as I said, we can look at lots of different time frames. So if you particularly like to swing trades, you will find that you will find setups here across the weekly, the daily, and the 4-hourly. If you are an intraday trader, then by all means, the 60, the 15, the 5-minute, 30-minute, they are very useful charts as well. And whilst undoubtedly they will set up on the 1-minute charts, it might be just a little bit too fast to be able to identify the setup and position size accordingly to get the trade on. So if you're new to trading, I would suggest not trading anything lower than the 5-minute charts. And actually, if you're an intraday trader, you will find that you might get one opportunity a day on the 15-minute chart, and for many traders, that's enough. Okay, for many traders, that's enough. So, how are our charts set up? How do they help us? As always, my charts are set up always the same, always very simple. You'll see I have a blue 20 period, a red 50 period, and a green 200 period, simple moving average. Okay, that's what you'll see on my charts. I also have the little fractals, okay, which you might see there. If you're interested, I can show you them later where they are. The important thing is, as to the filters, that we're in alignment. And so what I mean by that is that for me to have a bias to the long side, to be a buyer, I need to see price above the 20, which is also above the 50. So in this particular case here, we've had price, it's above the blue 20, it's above the blue 50. Okay, that's what we need to see. That kind of filter is what is giving us the first element, okay, of what we're particularly looking at in terms of having a simple filter that allows us to, as I said, to identify where the best of these 3-bar reversal setups are likely to turn on. And on the flip side, okay, for a short, for a selling opportunity, once again, we want to see an alignment, then we want to see price below the 20, which is below the 50. Okay, that's what we're ideally particularly looking at. So that's just how your charts will be set up and so you can understand my charts when you see them with a few examples later on. So how do we do this? Okay, first point is define, is there a trend? Okay, define is there is a trend. Now, you hear me say it every week that good trends leap off the chart at you, but I appreciate, especially in the intraday time frame, that okay, it might not necessarily always be clear, but if you're struggling to identify if there is a trend, the reality is if you're struggling to identify it, there probably isn't a trend. Okay, don't fight the markets. Okay, and the way we're going to define if there's a trend is just using price structure and a moving average fan. And what I mean by that is that we want to see price is above the 20-period moving average, which is above the 50-period moving average to define an uptrend. Okay, so as I said earlier, price above the blue 20, which is above the blue 50. That happens, that gives us a bullish filter, so we'll be looking to be a buyer, and we're looking to be a buyer on a pullback to enter long, and I'll go through the specific details of this over the next couple of charts. Once we've identified, in this case, looking for an uptrend, okay, what we're waiting to see is we want to see price retrace towards support. Now, how do you define support? That support could be static, okay, like a static support and resistance level, which you might have drawn in on your chart. It might be a big round number, okay, like, I don't know, let's say $2,000 in gold, okay, or 2,000 in the Russell, big treble zero numbers. Or, and this is my personal favorite, is it might be we've fallen back to dynamic support, which is namely the moving average. And in particular, let me just clear this up. In particular, I kind of like to see, when price is in that trend, okay, when prices hit the filter, and then it will fall back to the 20 and the 50-period moving average. And hopefully you can see there's a couple of examples of that there. Okay, so that is prices in an uptrend, it falls back, okay, retraces to support. and that can be dynamic in the version of a moving average, or it could be static, so maybe a horizontal level of support resistance, maybe a big round number, etc., that we've seen price is interested in. So that's what that's kind of the second step of what we are looking for. Once we've retraced, once we've retraced back to support, what we're looking for, and this is clues in the name, 3-bar reversal. We are looking for 2 red bars, two seller bars, followed by a green bar, So just keeping it nice and simple. At that support level we've retraced to, if we have 2 seller bars, 2 red bars, followed by a buyer bar, my buyer bars are green, then we have the initial setup, to look to trade in the direction of the overall trend. So what we've been looking for here, price, has been above the blue 20, which has also been above the red 50. So we've got that trend filter. We can see that price has been moving up. We can see price has retraced. And what we have here is, let me just... I'm a better trader than I am an artist, so please forgive me. So remember what we're looking for: 2 red bars followed by a green bar at a retrace to the 20-period moving average in this case. So here's candle 1, there's candle 2, and there's candle 3. 2 red bars, tick, 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 followed by a green bar, tick. That we have a 3-bar reversal. That's what we have. We have a 3-bar reversal. Now we just need to confirm a couple of elements, and we are looking to take a trade in line with the trend. What we're looking to do is a price has been an uptrend, price retraces, and then we're looking on the pullback as an opportunity to rejoin the existing dominant trend. That's what we're looking to try and achieve. So, as I said, the most simplistic view is that it's 2 red bars followed by a green bar. That's actually really all that needs to occur. But what I've found with experience over the years is if the buyer bar is something like a pin bar rejection candle, or a bullish engulfing candle, or an inside bar, or a spinning top, then that gives me much more confidence. So in this particular case, 2 red bars followed by a green bar, you can also see that green bar is also, a bullish pin bar, It's a bullish rejection candle. So when I see price action there in the 3rd bar, that can actually also give me great support, gives me much more confidence in terms of this is a buying opportunity, and that's what I want to particularly look for. So if you've identified it, how do we trigger? Well, for the standard setup here that we're going to talk about today, we enter 1 pip plus the spread above the high of the buyer bar. This is the standard set, 1 pip plus the spread. So, maybe you're trading this on your dollar. So, the spread there is about 1 pip. So it's 1 pip plus the spread. So 2 bars, 2 pips above. That is where you'd be placing your entry to go long. Our stop loss is 2 pips beneath the low of the 3 bars. So we've got the bars here. The 3rd bar is also the lowest, so our stop loss will be going 2 pips beneath the low of those 3 bars. Our target is 1.5 times our trade risk. What does that mean to new traders? Well, it means that if the trade risk between our entry and our stop loss, let's say that is 30 pips. Let's say that distance there, between our entry and our stop loss, if that is, for example, 30 pips, well, then our target, we'll be looking to 1.5 times our trade risk. So what we'll be looking for in that case is, if it's 30 pips of trade risk, we'll be looking for 45 pips for a trade target. And that's for people who use targets. And that's what I particularly do. I'm as I always say, I'm an ex-Air Force guy. I like to hit targets. That's what works best for me. But I do appreciate that some people prefer to trail their stops instead, and that's absolutely fine. If you are someone who prefers to trail their stops, then what I suggest is that you utilize a 3-bar trailing stop. So you've got a 3-bar reversal into a 3-bar trailing stop. And what does that actually mean? Does that mean that once your trade is triggered, every time a new bar closes, we trail our stop loss underneath the low of the last three candles when you're in a long position, or above the high of the last three candles for a short position. So in this particular case, let's say we have been, we've entered here and our stop loss is here. Every time a candle closes, we look to keep our stop loss beneath the third of the lowest. So in this particular case, when this candle closes here, candle closes there, we look at what were this candle and the last three candles, where was the low, and this is where our stop loss now moves, to 2 pips beneath the low of that candle. And that is what we actually do every time the price moves. Okay, every time the price candles, what we look to do is basically move our stop loss behind, in an uptrend, behind the low of the last three candles. So it's quite simple, it's quite mechanical, it's just following the price, which means that on days where maybe price goes sideways, you might get stopped out sooner than you'd like. But on days where we're at the start of a really great trend, you have the opportunity to ride that trend as long as you possibly can. So I appreciate that some people love to use trailing stops rather than targets. Here are a couple of additional rules here in terms of trade management for us. Okay, in terms of simple trade management, if your trade has not triggered after 3 candles, then take the candle off. Okay, so here, hopefully you can see, remember what I was saying is that, 1 pip plus the spread. So let's say our entry order was here and our stop loss was here. But we can see in the next candle, price trades up beneath it and triggers. But let's just say, for example, that maybe the price had just gone sideways for a little bit for 3 candles. And let's say this was a 4-hour chart here. And, so effectively 12 hours later, 3-4 hour candles later, it has still not triggered. Well, then basically take the candle off, because what we're actually looking for is price to go up, to retrace, and then for the dominant trend to be strong enough to take the price forward. If price isn't strong enough, if that dominant trend isn't re-exerting itself fast enough, well, then the likelihood is that maybe it needs to go sideways, or it might actually still want to sort of pull back even further. And that's that's another thing, okay, is that if price does continue, let's clear these drawings, should price continue and close below the low of the 3 bars before your buy order was triggered, then take the trade off. So once again, if we've had it here, and our stop loss is here, and then actually what we see is price trades through where our stop loss would be had we been triggered in, well then take the trade off, because clearly what's happened is the price needs to retrace further and needs to retrace deeper before it's ready to move. And that's one thing we are particularly keen to look at and take on board. So Simon asks, hi, is that blue line the 50 period moving average? No, Simon, it's not. The blue line is the 20 period moving average. The red line is the 50 period moving average. And then the dark green ones you'll see on my charts, that's the 200. Okay, so the 20 is a particular favorite one of mine in terms of a price where it retraces to that zone. But really anywhere between that 20 to 50 period moving average, that sort of, the price actions, those zones, that is an interesting place, okay, to look for these reversals to trigger. Okay, so what do I say to people and stuff when doing this? What I suggest is challenge yourself. Okay, challenge yourself to do 20 of these trades and then evaluate. Very often, excuse me, very often what we see is that a trader might try a setup like this, but you might only try 3 or 4 of them, and then if it doesn't work well enough or it's not quick enough, they get a little bit frustrated and move on, and then invariably they spend their life just basically chasing their tail looking for the next best setup. When in fact what I suggest is do 20 of these trades. Okay, do 20 of these trades, keep records of them, and then evaluate the numbers. What you'll tend to find for what we talked about here, for the kind of the standard trade setup, your hit ratio, okay, in terms of your right wrong, will veer between about 48 to 62%. Okay, that is with a 1.5 reward to risk, okay, on your trade for targets. So, for those of you a little bit more advanced, you might want to be considering, well, okay, does that give me positive expectancy? Well, if you've got if you're getting your hit rate 48 to 62% and you've got a trade, your reward to risk is 1.5, R to R, well then you can probably do the maths on the back of the fag packet to understand that, okay? And if not, well then there's a little bit of homework for you. Go away and understand what positive expectancy is when it comes to your trade setups, okay? But as I said, look to do these in blocks of 20 trades, all right? Blocks of 20 trades is the way you want to be particularly operating. So that was the long trade, and really the short term, a 3-bar reversal short term, the setup is exactly reversed, okay? However, now what you'll be doing is you'll be looking for 2 buyer green bars, okay, followed by a seller, which is red on my charts at resistance. So, price is in a downtrend, price is beneath the 20, which is beneath the 50. We get 2 green bars followed by a red bar, okay, 3-bar reversal. 1, 2, 3 before you can see we make a nice move down. That's what we're looking for, okay? Let's just, that's what we're looking for, okay? That's what we're looking for. Nice moves like that, okay? Just an opportunity to join the new trend on a pullback so we can get a better price, okay? And give us an opportunity to ride a little bit lower. That's what we're interested in. That's what we're looking for. So just a couple of examples here. I've tried to put in a whole host of different examples, different instruments, different time frames, etc. This is pound against the Swiss franc on the daily chart. You can see that price has been in a very nice trend, and actually what you do, you actually have a 3-bar reversal there. However, what has happened is even though price has moved to push up, if you notice, the 20 is not above the 20 is beneath the 50 there, okay? So for the standard setup, remember what we need to see is we need to see price, okay, above the 20, which is above the 50. That's what we want to see, and we have to wait a while. But then actually, what we do is we get here 1 candle, 2 red candles, 3rd candle, which is also a bullish engulfing candle. Remember, that's what I like to see. And so basically your entry is, 1 pip plus the spread above with your stop loss beneath, and then price shoots its way up then continued quite nicely, okay? So that's on the daily chart, okay? And as I said, I've got a few different examples in here just to give you an idea of what we're particularly looking for. So let's have a look. This is from a few years ago, but the reason I've included it is because actually this was an interesting one over a summer about quite a few years ago. But the price action is the price action. Okay, that's what we're looking for to take on board. And this was the Aussie against the US dollar. Now, I also in my FX trading, I also like to use to look at strength v weakness. I have my own way of doing that. All right, and I use a thing called the STAM, a proprietary model I built. But at that time, also what we had was that the US dollar was very strong and the Australian dollar was very weak. So I was already looking to have a bearish inclination. I was already looking to be a seller. And what we can see here is that, price was beneath the 20, which was beneath the 50. We were in a downtrend, and then bang, we pulled up. And now 2 green bars followed by a red bar, and we drop. Then we pull back. 2 green bars followed by a red bar, okay, and actually we trigger, but actually it takes a while for us to achieve our targets, but we don't get stopped out. What we do have then, once again, 2 green bars followed by a red seller bar, and off we go. Price back in, 2 green bars followed by a red seller bar, and we drop to a target. We pull back, 2 green bars followed by a red seller bar before we drop back again, okay? Then we pull back here, 2 green bars followed by a red bar, and then I think actually, if I remember right, we dropped down towards the 20. But what I wanted to do is just show examples that that this is very rare. I will admit this is rare, but just to show you that actually, it's a very simple mechanical price action setup, okay? And we have the filter in place to understand whether we have a short bias or a long bias, and then once you've identified the bias, you wait and see, does the price action actually sort of suit us in terms of do we get a nice, in this case in a downtrend, do we get a nice pullback, okay, followed by a 3-bar reversal, 2 green bars followed by a red bar, okay, and is the red bar, is the 3rd bar the trigger bar? does that also, is the price action with that? Is it something like a rejection candle or a key reversal or an engulfing candle or a pin bar or a doji or spinning top, etc.? Because that just adds to our interest. So that was just a unique summer that was in terms of just how to trade the Aussie dollar. And this is the euro yen on the weekly chart. Okay, price had been actually working its way down, and now price is beneath the 20, which is beneath the 50. Price pulls back. Okay, we get two green bars followed by a third bar. The third bar is also a bearish inside bar, so the trigger bar's got some good characteristics about it, and actually we can see that we dropped our way here then. Just as an aside, okay. Some people might look at it and say, well, actually, Paul, wasn't this an example of got two green bars followed by a red bar? And you're absolutely right. The reason I didn't look to take that trade is we had already moved. The candle had moved hugely, okay, and remember what we're saying is that we are entering beneath the low with our stop above the high, and so on the weekly chart our actually trade risk was quite huge, quite bigger than what we were normally expected to look at. Now, what you might say is, well, actually, it would have hit its 1.5 target, but you don't know that at the time. Okay, so what we particularly, and let's clear these drawings up. What I particularly like is, something that gives me a nice sort of trade risk, because that means the opportunity to hit my 1.5 trade reward to risk is increased, rather than a huge third candle. Okay, in which case the move has already been made in that sense. Okay, so just to give you further insight. This was, once again, this is Aussie dollar, but this is on the hourly chart now, okay? And this just shows that how, once price gets into a good trend, okay, it is not a surprise to find that, basically price never moves in a straight line. It moves in a zigzag, and here, two red bars followed by a green bar. Here, two red bars followed by a green bar. Two red bars followed by a green bar. Here, two red bars followed by a green bar. Okay, that's what you're looking to trade to achieve. Okay, in that nice uptrend. Okay, and as I said, we're not looking at the individual. What I suggest is, if that trade sets up, take that trade and then basically collect a sample size of 20 trades, and then once you've got 20 trades, go back and look at at the overall hit rate, at the overall profitability, etc. And that's the way we look to operate in terms of just a simple sample size that basically allows us to do it. Because what we'll see is that, as I said, very often, markets only trend 20 to 30% of the time, which is one of the challenges we have. But when they do, it is our job as traders to try and harvest as much as we can from those trends when they occur. Examples here on pound against US dollar on the daily chart. Okay, so we can see here that price has come in and it's moved away, but I'm more interested here in that, having moved away, price pulls back. Some people would actually just be looking at that as a bull flag. Okay, and that's absolutely fine. It just gives you more confidence. But the important thing is that price is above the 20, which is above the 50. We have two red bars followed by a green bar. The third green bar is, it's a little inside bar. It's a spinning top bar. It's like the rest before the surge, and then actually what happens is price launches itself off up there. Okay, that's what we're particularly looking at. That's what we're particularly looking at there. And a couple of examples here just on the euro yen 4-hour chart. So you can probably see, as I said, a lot of my trading's on there. Sort of swing trading on the FX markets, but what we're looking for is that kind of simple, just something simple that you can utilize as a way to join an existing trend. So price has been an uptrend, it's been above the 20, which has been above the 50, price pulls back. One bar, two red bars. The third bar is the green bar, which is also very nice. It's a nice, bullish pin bar. It's a bullish rejection candle. It's closed above the 20. It doesn't have to do that, but it's, that's nice. Price moves up, then price pulls back again, doesn't it? And what we get is two red bars followed by a green bar, which is also a kind of, a bullish engulfing candle before price pushes its way up there. Okay. So, as I said, it's a case of markets don't trend as often as we'd like. But when they do, it's our job to be able to effectively, harvest as much as we possibly can out of those trends. And 3-bar reversals like this is a way that it allows you to do that. Just a few points to note. Okay, so the 3-bar reversal is a simple mechanical pullback trading tactic. That's what it is. Okay, and so for some traders, for new traders, that can actually be really helpful to actually have a simple mechanical pullback trading tactic. And we walk through the simple points for it. One, define if there is a trend, and you define if that trend for an uptrend. Okay, if you've got a bullish bias, that comes from if price is in an uptrend above the 20 and above the 50. Okay, and a downtrend, all right, that is price beneath the 20, which is beneath the 50. That's what gives you your bias. Once you've identified a suitable bias, well, then you're looking to wait for a pullback to support in an uptrend or a pullback up to resistance in a downtrend. If we are, if we've got a bullish bias and we're looking for a long opportunity, we need 2 seller bars followed by a buyer bar. All right. And for a short sell-up, if we're in a downtrend, we need 2 buyer bars followed by a seller bar. And remember, it's where the setup appears that is key. We've got the filter, but equally, I like to see pullbacks to a level of static support resistance, so a big round number, a horizontal line, or a dynamic level, which is towards a moving average. And as I said, that in particular, I like to see price pull back in towards the 20 and the 50, and then reverse off that. That's what I personally, my particular preference. But other people may see that differently. Other people may wish to do that differently. My view is that you should keep it nice and simple. Okay, just keep it nice and simple, nice, easy trading tactic that people can follow. Okay, and as I said, doesn't matter whether you trade daily charts, weekly charts, or whether you trade 5-minute, 15-minute charts. Okay, there are opportunities like this will arise, and it's about you being ready to take them when they come your way. Before we go to the live markets, just remember, we have Monday Market Matters every Monday, London time, 2:00. And we hope you'll join us because it's going to be a rather interesting year in markets, and I hope you'll be with us to enjoy that journey. From what we've talked about today, the 3-bar reversal is a simple mechanical pullback trading tactic, and what's important is to define where that 3-bar reversal occurs. Okay, so we have the filter we're looking for, and also we're looking for where does the pullback come back to. All right, and as it says there, we need to occur as part of a pullback in a trend at a suitable level of support in a bullish bias, or a suitable level of resistance in a bearish bias. That is what provides us with the confluence of events. Okay, those of you who join us every week will know I talk about it all the time, about a nice confluence of events that gives us that opportunity. And the important thing is it can be used across all instruments and all time frames. So it is a simple trading tactic, and I've taught lots of people to do that, and they'll go away and trade it on intraday basis, or they'll trade it on a swing basis, or they'll even trade it on an end of day basis. Okay, because sometimes, as I say, a simple mechanical trading tactic is what suits people once you've learned to identify what the actual setup is, and actually when you see it. We're going to switch across to the live markets, okay, and have a little look at what's been going on in the openings of the start of the US session. Before we do, just a reminder that next week's session will be here, 25th of March, 2:00 London time. And what I'm going to be doing is how to use the key reversal candlestick. So this is the session that I delivered at the recent London Trader show. So if you're there and you saw us there and you joined us, this is an opportunity to see a replay of that if you want to be able to take notes. And also, of course, the session is recorded. So, of course, once it's recorded, it then goes up on the ActivTrades webinar archive, which you have access to. So that's next Monday, 25th of March, 2:00 London time, how to use the key reversal candlestick. I hope you'll join us if you can either register on the website if you haven't done already, or just use your mobile phone to look at that QR code, and that will take you to the page to be able to register. And it was great to be able to give that presentation at the London Trader Show. It was great to get all of the questions. It was great to get all of the feedback. Okay, and so hopefully you'll find that useful next Monday as well. And so I look forward to speaking to you then. Okay, so let's switch across to the charts. Okay, we'll have a little look at that and see what's been going on. It's a case of if you've got any questions or comments or thoughts or feedback, or maybe there's even topics you'd like to see me cover, well, by all means, you can get in touch with us here. You've got the London number for the English desk, which is 0207 6500 567, or email englishdesk@activetrades.com. Okay, and we, as always, we like to hear the feedback, and we love to hear from you. So if you just bear with me for a moment, just hang on for a moment, I will switch across to the live charts and we'll take a look at what's going on in the markets today. So just bear with me one moment. Okay, so what I'm hoping is that you can see the sort of the ActivTrades platform, and that you can also hear my voice still. I'm hoping that, and that's great if you can. Yeah, I was looking at trades here and stuff. Before we look at the American markets, let's have a little look at last week. Okay, so just looking at last week in the trading markets and stuff, and actually what we had was sort of Thursday of last week, I think it was. We were trading here on the DAX. So yeah, here we go. This is the DAX from last, I think it's Thursday session, if I remember rightly, and stuff. And what we had here, this is the DAX, the 15-minute chart, and I'm hoping, let's just draw this in. What we had was here, we had basically, we can see price was in an uptrend there at the start of the European session time. And then actually what happened, price was now above the 20, it crossed above the 50. So we had price above the 20, which was above the 50. And then actually what we had was a 3-bar reversal, 2 red bars followed by a green bar, because we're in a bullish trend. And actually we were able to trigger in, okay, just above. And our stop was a couple of pips beneath, okay, a couple of points. And unfortunately, what happened is we literally got sort of stepped out by one tick there, okay, on that, which is frustrating, but just goes to show, there is no such thing as perfection, okay. But here's the interesting thing is that having had this trade set up. This basically trade setup failed on us. What actually happened is the trade set up exactly again. We had 2 red bars followed by a green bar. Okay, that's the way we did. Okay, and so we were able to enter the trade 1 pip plus the spread above, which is only 1 pip, stop loss beneath the low, and then hit our 1.5 reward to risk. Okay, so you took 2 trades, 1 win, 1 loss, but we were up half an hour, okay, at the end of those 2 trades, and that's just to show you that nothing is ever perfect. But let's clear this down. Here, this was an ideal setup for them. It was a 2 red bars followed by a green bar. The green bar was also a bullish pin bar in a nice uptrend, okay. And so it was a perfectly good setup, but actually in that case it failed. But it weirdly set up straight again, and then that actually went. And so that's what happens to us as traders, doesn't it? It's not always pretty and picture perfect. You have to trade what you see in front of you, and it's easier to do that when you have a good set of simple rules that help you to do that. We actually had it this morning as well on our S&P 500. Once again, a kind of a similar situation, weirdly, in that price here, S&P 500. Oops, that's terrible. I apologize. My mouse today is clearly been a little bit sketchy. We had price in uptrend. Price was above the 20, which is above the 50. Price actually pulled back to the averages, and we had 2 red bars followed by a green bar. Okay, and actually what happened is that we didn't get really sort of we kind of worked our way down. Remember what I was saying is that basically that didn't trigger because price traded beneath the low of the trigger candle before trading higher. So actually, even though it was a setup, it didn't trigger. Okay, it didn't trigger for us. Okay, that's that. That can happen. But actually, weirdly, what happened is price pushed its way up, and then what did we have here? We had two red bars followed by a green bar. This is an interesting case because the second bar, okay, that was the lowest of the three bars, and then we had our green. We had our green, which was also a bullish pin bar, and so invariably we had our Bosch. We had our trigger above the high, stop beneath the low, and then basically we were triggered in and away we went. Okay, and that hit its 1.5 rewards a risk target, but you can see if you had, this was one of those days where if you'd been trailing your stop, it would have been a fabulous day, but it always looks great in hindsight. As an example here as well, so what we've seen here is just to give you, is that price has clearly been an uptrend and it's raced away, and what we have seen here is that, what have you got there? Two red bars followed by a green bar. The green bar is also it's a nice little bullish pin bar there. Now invariably that looks like a 3-bar reversal, and there's some people who would happily trade it. And of course, we can see that it actually did fly very high. But remember, you don't know that at the end. You don't know that at the time. What we're always talking about, remember what I was saying, is that what we want to see is price basically retrace into a level of support. In this case, you've got the 20 period moving average there. You've also got the high of the Asian session there. Whereas here we're in, we are in sort of, we're in no man's land really. Okay, there's no real big number there. Okay, there's no real sort of support resistance level. So that would not, for me, that would not meet the criteria. Okay, I want price to basically, once the trend is established, I want price to retrace back to a level of support, then put in its 3-bar reversal before I go. It's a good example to show you just what we're looking for in terms of the rules that we're looking to apply. And even the CAC, okay, the French last week, okay, gave us an example, and I kind of liked this example here. Okay, for those of you who are indices traders, 15-minute charts is very nice to be able to trade indices on. Is that invariably, price was in a very clear uptrend, wasn't it? In a very clear uptrend. Okay, it's nicely above its averages. Okay, it's working. It's just working its way nicely, and then what happens is price basically retraces, and it retraces to the 20 period moving average. What happens is, we have one red bar, two red bar, and the third is a green bar, okay, which is also an engulfing candle. It's also a key reversal candle, okay, and you can see for yourself that actually it worked quite nicely up to its 1.5 reward to risk. And once again, if we look at it here, just let me clear this down. This in itself, okay, was also a 3-bar reversal. Price is in an uptrend. It pulled back. We got two red bars followed by a green bar, and the green bar is also a pin bar. But this is late into the US session, okay, and generally, as a rule, when it comes to indices, I will trade like UK and European indices in the morning, and then in the afternoon, I focus on trading the US indices. So it was a perfectly clear example, and it worked its way up there, but invariably it's just late into the day for the French, for the CAC, when in fact my focus is on the in the afternoon. My focus is on the US sessions there. Okay, so hopefully that just gives you a little bit of example, just some recent examples, just in the last few days. Okay, of sort of just the trade setup, and once you learn the trade setup, okay, you'll be able to identify it very quickly with your just your own cognitive recognition skills to be able to pick up on that. Okay, just practice at understanding the exact rules. They're not desperately difficult. With a little bit of time and energy and effort, you can pick up on them very, very quickly and understand them. And then, as I said, look to trade a sample size of 20 trades. Okay, and then have a look at how that has particularly played out for you. Okay, so these are the US indices. Remember what I was saying is that they have jumped to summertime in the US earlier than we have, hence why normally I'd be talking about how the market had been open for about 22 minutes now. In fact, it's now been open for about an hour and 22 minutes, and that's what we're particularly looking at. There, this is the sort of the Dow, and actually, excuse my drawings here, but I'll just really, here we go. If I look at us there, this is a daily chart. We've been in that block now for a month, okay? And my view would be that we will probably stay in that until the FOMC announcement on Wednesday. That will either take the wind out of the sails, okay, and we'll roll over, or it will basically ignite another pump, and we will break out of that. Okay, so the kind of the longer term swing trader in me, that's what I'd be particularly looking at. Okay, on that, but even just here, I'm looking, the three bar reversal there, actually a 3-bar reversal there. Okay, so they are, as I said, they're on all time frames, all instruments. Okay, you just need to train your eye to be able to recognize and see them, when they actually occur. But anyway, let's have a little look at what we're looking for in terms of the intraday basis. So we can see that we've already we had a bit of a bullish European session, and now we're into that US session. So I'd be interested to look at this. We're kind of in the middle of nowhere based upon where the highs and lows from Friday were. Okay, so if I just start to look down at how did we break out in the first hour? That's what I'm interested in. So I'll just drawing and just looking and seeing where there are particular areas of interest that might be of interest to me. So just looking, we're around the 15-minute 200 there. We had false breakout there and then fell away. And that's a 5-minute chart. That's actually very nice false breakout there on the Dow from the sort of 30-minute opening range. But it looks like we're going to have another go and another assault on it. So we are 5 minutes through. So what I'll be looking at is, if price comes up and breaks the kind of the high of the 30-minute range, if it breaks above and close it, that would be bullish on the Dow for me. Okay, that's what I'll be watching there. Clearly Nasdaq, okay, has just gone even, it's gone even wilder, hasn't it? It's just absolutely just flown its way there, hasn't it? So if I look at that on the 15-minute chart, so we looked earlier at the S&P 500, but actually, if you look at that there this morning, okay, price is in a very clear uptrend, wasn't it? And then we had basically 2 red followed by a green, and basically price moved its way up there nicely, and it's gone much further. But that woulda, coulda, shoulda. You don't know that. You only know that in hindsight. It's always easy in hindsight. Okay, so let's have a look at how we've started here for this week. Bang. Let me just. Whoop. So. Just looking at the kind of the early morning range, how we played that, we're up above it, and can we hold above it? I'm just looking at, to me, that's a bit of a double top there on the actual Nasdaq. Even though we've had a big bullish move, I'd look at that as a bit of a double top. I would want to see how does price hold? If price gets back up above the kind of the high of the 30-minute range and holds it, that would be bullish. But I'll be watching to see how price reacts over the next. I'll be looking at that over the next 10 minutes and stuff to see if it looks like it's going to roll over. I'd be trading it back to Friday's high there. Okay, on a short term basis. Let me have a little look on the short term. I'll just be watching this to see if it just drifts up there up to that kind of 18,360 level, and if it does, how does it play out? So I'll just maybe it's here, maybe it's rolling, maybe the double top is rolling over on that. S&P 500. Well, we looked at that this morning in terms of there was the three bar reversal there for us, and if I look at the 30-minute range, that's this one. Interestingly, just excuse my drawings. I need to improve that. We could be much better. 15-minute chart, 5-minute chart is above that range, and see, that's what we're talking about. Whereas the Nasdaq is beneath the high of the 30-minute opening range. Okay, here we can see the SP is already above it, and can it hold above it? That's what I'll be looking for. If it can hold above it, that's very bullish. That is very bullish. Whereas the Nasdaq couldn't seem to hold above it, and the Dow at the moment doesn't seem to be able to get up above it there either. So yeah, it's a little bit mixed, but I think it wouldn't surprise me if we took a little bit of a roll first, maybe we kind of drifted for the next 15, 20 minutes downwards, before it decides where it wants to go. I'd be looking at focusing at the Nasdaq and seeing whether whether it gives me a short term opportunity to trade back towards the yesterday's high as a first interesting level. So we shall wait and see. I'll watch that myself over the next 10 minutes or so. Okay, ladies and gentlemen. All right. So there you go. Time flies when you're having fun. We draw that to a close for today's session. I hope you found that useful. I hope you found that interesting. I hope that's given you an indication of a very simple mechanical pullback trading tactic that you could take away and utilize in your own trading. All right. So it's not difficult. Remember, this video will be up on the webinar archive, so you'll be able to watch it in a day or two's time. Take the notes. As I said, start to look at trading it in samples of 20 trades, see how that works for you, and then develop it from there. As always, I wish you the best of success in your own trading endeavors, ladies and gentlemen. Hope you have a fabulous trading week. As I said at the start, it's going to be a very busy, very chunky, very news-heavy week. So be sure that you know what the news is, and be sure you keep your powder dry for the best opportunities. And I hope you'll join me next Monday when we talk about the key reversal candlestick, which is a repeat of the London Trader Show. Have a great trading week, everybody. Trade well, and I'll speak to you soon. Many thanks.